Good morning. My name is Alla McCoy. I'm Director of Startup Support at the University of Maryland's Ventures. And I would like to welcome everyone who joined today's workshop. And today we will cover a very important subject talking about funding for University of Maryland startups. This workshop is put together by Ventures in collaboration with Dingman Center for Entrepreneurship at the Smith School of Business and MTech at the Clark School of Engineering. You will have an opportunity to ask your questions. Please feel free to submit them by using the Q&A function, and I will see that there's a question. You can submit them anonymously if you wish. As I mentioned, we are recording this session. It's going to be posted on YouTube. So if you wish to remain anonymous, you can choose to do so. Well, again, thank you for joining, and let's begin our topic. Let's begin talking about funding. Well, before I talk about specific funding opportunities, I wanted to spend just a few minutes covering some of the terminology that I will be using throughout the presentation. And I'm sure some of you probably already know this, but for those of you who don't know what this means, these are really important terms to understand. So first, all funding can be either dilutive or non-dilutive. What that means is dilutive funding, the funder takes equity position in the company. An example could be a venture capitalist. They will give you, for example, $1 million for 25% of your company. Well, now that dilutes your equity in that company, and that's why it's called dilutive. Non-dilutive funding the funder does not take equity position in the company, and examples could be grants or loans, and they do not take shares of the company, and therefore do not dilute already existing owners. Well, the first type of funding that a company usually gets is self-funding. It's non-dilutive because obviously you already own the company. It's really important because it proves commitment and skin in the game to future investors. If you down the road pitch angels or venture capitalists for them to give you their money, they will usually ask how much of your own money have you put into the company. And if you say none, that's usually not a good indication to them, because you're not willing to risk your own money, yet you are asking them to risk their money. That's usually a red flag. Obviously, there could be a reason for that, but you should explain why. You have to be very careful. If you put money in your own company, you have to be careful not to risk your family's financial security. So mortgaging up your house is probably not a good idea, even though we always hear these stories about how these entrepreneurs who are now mega successful maxed out their credit cards to make their first product or their first batch of product. That's usually not a good idea. And whatever personal money that you invest, you should have support of the family, and family has to understand that this money could be lost and be okay with that. So again, really important to have family support for that. Now, grants are some of the best ways to finance early stage startups. They're non-dilutive, so you keep building a company without giving away your equity when equity is really cheap. And so you are waiting to give up your equity for later when it's a little bit more expensive. That's always a good thing. Grants don't need to be repaid. That's another great thing. However, when you are applying for grants, keep in mind that it takes time. Most of the grants take time, and most of them have specific deliverables. So if you take out an SBIR, for example, there are very specific deliverables which you need to deliver at the end of the grant period. And so you have to be you have to make sure that those deliverables actually align with what your company, with the goals of your company, so that you are not just taking out grants to build this and that, but so that you are building things that are actually in line with your company's strategy. That's really important. Also remember that grants always have reporting requirements. It's important to adhere to those reporting requirements. But all in all, these early stage grants are one of the best financing mechanism for early stage technology startup. And I will talk about some of the most widely used grant opportunities available to University of Maryland startups. Next comes debt financing. You don't see a lot of this in early stage startups because early stage startups are very, very risky, and usually banks don't, the risk that the bank is willing to take doesn't align with the riskiness of early stage startups. So you usually don't see that. However, it would be available down the line, or for a small business. So if you're running a small business, SBA facilitates loans for small businesses that are backed by the federal government. So you can find out about that at the website that I'm listing. So again, debt financing usually are bank loans that have to be repaid, and usually they will require collateral. So if you are taking out a bank loan for a company that doesn't have a whole lot of assets, which is usually the case for early stage company, they will ask you to put your personal property, such as your house or something else, as a collateral. And they will collect on that. So you have to be very, very careful with that. The next type of equity of funding is equity financing. So equity financing is usually first done by friends and family. So you are looking to build a company, start a company, and you tell your friends and family to see if anybody's willing to invest. You have to be very careful taking money from friends and family. It's also called Friends, Family, and Fools Round, or FF&F. Make sure that you only take money from people who can afford to lose it, and whatever amount they can afford to lose, and then they understand that this is a play money, and they may lose it, because this could ruin family relations very quickly if things don't go as well. Next comes investment from angels or angel investors. So angels invest their own personal money, and therefore they usually are willing to invest at an earlier stage, because they're willing to take higher risk with their own money. And they usually invest less money than venture capitalists, so that therefore they usually come before VCs. Venture capitalists invest somebody else's money. It's usually coming from a fund that they raise, and they usually take a seat on the board of your company in addition to equity, and therefore they're looking to invest at a later stage than angels and higher amounts of money, so that they would be able, they don't want to sit on a whole lot of boards. So usually whoever, friends, family, and fools, angels, or VCs, they usually put cash into a company in exchange for stock. They usually take other controlling mechanisms in the company. They may ask for a board seat or two. You should always look for experienced investors, people who bring not just money, not just cash, but who can also bring their expertise, somebody who understands industry, who can introduce you to potential customers or potential clients, and somebody who has potentially done it before, or at least understands the risks, and understands that they shouldn't be micromanaging the entrepreneur. Also remember, the earlier equity financing is accepted, the lower the value of the startup, and therefore investors get bigger piece and more rights, but that may be perfectly okay as well. Especially if that investor also brings in other things such as network, introductions, stamp of approval in the industry. So that should all be taken into consideration. Well, now let's talk about specific funding sources for University of Maryland startup. If you are building a company at the University of Maryland or University System of Maryland, or with a technology developed here, you don't necessarily have to be a faculty or student, but if you're working to commercialize technology developed here, most of these would still be available to you as well. You're in luck. There are a lot of there's a lot of money, potential money available through the university. So first, usually it's a good idea to start with I-Corps, First Regional I-Corps, conducted here at the University of Maryland as a 2-week program. It doesn't come with any funding, but it gives you NSF lineage and ability to apply to the NSF I-Corps. That gives you $50,000 to basically conduct market research and customer discovery. This is usually done at a very early stage, in many cases, even before the startup is even formed. It's non-dilutive, it's a grant. And very important to remember is that participating in an NSF I-Corps program significantly increases your chance of obtaining not only TEDCO MII grant, but also very importantly, SBIR funding, SBIR, STTR funding. And as I mentioned, you have to have either NSF sponsored research to commercialize, to qualify for the national I-Corps, or you have to establish NSF lineage by participating in regional I-Corps. So the national program is a 7-week program. I believe they're still done virtually. Before pandemic, you would travel to a specific city to do this. Now there's no need to travel, but you still have to have, it's a lot of work, it's a serious commitment, but it yields great results. So I highly recommend. If you're interested, please visit icorps.umd.edu for more information. They are forming a regional cohort for January, so if you're interested in participating in that, you can apply. For those of you who are developing medical devices, there's help in the form of a small grant for 3 to 9 month project to advance technology up a TRL level. It's not managed by the Fischel Department of it used to be managed by Ventures, not managed by Fischel Department of Engineering. And if you're interested, please let me know. I will let you know how to apply. So the next important funding opportunity, and this is all before you even form a startup, by the way. So there's a lot of help even before you form a company or take a risk to do that. So next one is a grant opportunity from TEDCO called Maryland Innovation Initiative, or MII. MII comes in 2 phases. First phase is called technology validation phase. It's done again before you form the company, so you would apply, or if you're working with, if you're not a faculty or researcher here, you would work with one. And so a full-time researcher at the University of Maryland, Baltimore, College Park, Johns Hopkins, Morgan State University, and UMBC, researchers from those universities can apply for this grant. It goes to a researcher's lab, $115K. There's no overhead, so the entire amount goes to your lab to do a 9-month project. That's some kind of project that would validate technology and develop a commercialization plan. This money can be used for salary, PI salary, postdoc, or grad student salary. You can buy equipment, materials, hire contractors, rent equipment or buy equipment, whatever it is that you need to do to validate your technology. You also have to partner with a commercialization professional, somebody who could potentially be a potential CEO for the company, or it could be a consultant, somebody who would develop commercialization plan. You can also use this money to continue customer discovery exercises. Again, this is very early stage before the company is formed. It's non-dilutive, and you will receive help to create the application. You will receive help from a site miner. Site miners are industry experts, and they will guide you through the application and the project itself. Pardon me. So once you're done with your phase one, you have your commercialization plan, you have maybe a prototype of your technology developed, your product. Then you can form the company and apply for the next MII phase called company formation. So at this phase, it's the company that's applied, not the PI. And so it's a $300,000 funding that goes to the company. It is dilutive. It's a convertible debt note at 8% interest that could either be paid back or it could be converted into equity if there's a financing round. And the funder chooses which way to go. Even though it is a sort of a loan, you can look at it that way, but there are no personal guarantees. So it is very, very early stage financing that's actually really hard to obtain. And it is a fairly large amount of money, especially if you're building a company like software or any kind of product company where you don't need heavy capital requirements to build an actual product, a minimum viable product. Again, you would work with a site miner who is an industry expert and will help you apply for this grant. To qualify for it, the company has to be formed and technology licensed from one of the universities that I mentioned no longer than 1 year. And by the way, if you have any questions, please feel free to submit them and I can answer them. So these are metrics for the past 3 years. So you can see a fairly high application success rate, and not obviously not a guarantee, but in most cases it's somewhere between 55 and 63% chance of getting it, which is much higher than most of the grants or funding that people usually apply for. So I manage the application process. So if you're interested, please feel free to contact me and we can discuss what your next step should be. So once your company is formed, you have your prototype, you are gearing to commercialization, you can apply for Discovery Fund. It is Evergreen Venture Fund for Economic Development in Prince George's County. You don't have to be a University of Maryland or any other university startup. The only requirement is that the company has to be located in Prince George's County. This is seed stage, pre and early revenue. And with the initial focus on quantum and advanced computing related companies, however, other companies are also considered. In fact, they just made an investment in a healthcare company, so don't necessarily have to be a quantum. There's a $1 million allocated annually to the Discovery Fund, so that's what they have to invest. Investments could be either non-dilutive in the form of grants, those are the smaller amounts, or dilutive capital in the form of preferred equity or convertible debt note or SAFE. And those usually higher amounts. So Stan Smith, venture investment manager for the University of Maryland, manages it. His contact information is listed there. So if you think you qualify or you're interested in learning more, please contact Stan. Another great research and development grant program at the University of Maryland is MIPS, or Maryland Industrial Partnerships. It's highly cost effective. The company puts in $10,000 and university matches it with $90,000. So there's $100,000 budget that goes to a lab at any of the university system institutions. So there are 14 universities within the university system. So if there is a researcher or a lab at any of these universities that can do a project to move your technology along, such as testing, further development, this could be a highly effective way to get it done. It could be done either for research and development or for education and training as well. It's managed by MTech. Ronnie Gist is the contact person, so please feel free to reach out to him or visit their website for more information. But again, this is a highly cost-effective way to advance your technology. RTMS MIPS is a specific opportunity for collaborative research projects between US-based companies and faculty from University of Maryland College Park and University of Maryland Baltimore County. It's specifically for robotics systems and smart devices that work intelligently in cooperation with each other and human actors across multiple domains. So this opportunity provides higher funding, but for very specific cases. It's also managed by Ronnie, so give him a call if you think that you are interested in this. Another specific opportunity, Chesapeake-based Seed Capital Fund provides investments for companies that can demonstrate a quantifiable reduction in nitrogen, phosphorus, and just sediment in the Chesapeake Bay. So if you're building a company that has anything to do that could affect cleaning up the Chesapeake Bay, please give Scott Christensen a call or send them an email. They do make up to $500,000 dilutive equity investments in the company. If you are a University of Maryland system, so not necessarily College Park, but university system, student, alum, faculty, you licensed intellectual property from any of the university system of Maryland institutions, you could potentially qualify for Maryland Momentum Fund. It's a $10 million venture investment fund, and they do make equity investments. So those are dilutive up to $500,000. You have to have a matching investment. So you have to have an investor who already committed to investing in you, and they will invest alongside. So if you're interested, please contact Mike for more information. And then next, I will talk about SBIR. Many of you have heard about SBIR and STTR. It's one of the best ways to finance R&D in early stage company. So we do have a separate 2-hour workshop covering SBIRs and STTRs in a lot more detail, but here I will just provide very high level details. This is a gated process with 3 phases. So phase 1, concept development, provides $150,000 to $250,000. And then phase 2, that's where the big money comes in, prototype development, more than $1 million and more. So that's where the big money comes in. Each individual agency, government agency or federal agency, has their own SBIR process. So even though the SBIR is managed by the SBA, but each agency has their own announcements and their own program managers. And so these are the agencies that participate in the program. It's best to reach out to program managers directly at these organizations and ask them questions about specific funding opportunities to see, do you qualify? How can you improve your application? There's also a lot of help available. In particularly, TEDCO is actually recruiting people for an SBIR lab where they will create a cohort of people and they will work with you on writing your SBIR and submitting your SBIR application. There's also help at the University of Maryland and through the Small Business Development Center. And next funding usually comes from angels and VCs. As I mentioned before, the difference between them is that angels invest their own money and VCs invest somebody else's money. They invest only in high growth startups. So if you're trying to open a lifestyle business such as a restaurant, a hair salon, or something like that, or any type of business that you would like to create and open and operate for a long time, that's not the right fit for angels and VCs. They usually look to invest in a company that's going to grow really fast and that's going to be sold within the next 5 to 10 years. Because since they take equity, they don't loan money, they take a piece of company. The way that they actually get paid back is by getting the proceeds from the company sale. So again, really important to take smart money. Money from angels or VCs that don't come, not just cash, but also people who have experience and can open up their network and also expertise. That's really important. At the University of Maryland, Dingman Center for Entrepreneurship operates an angel investor group. Stan Smith also runs that group as well. And they are looking at monthly opportunities from regional companies. So you don't have to be University of Maryland or any university startup. So any startup can apply for an opportunity to pitch their angel investors. It's one of the more active groups in the region. There are Citrine Angels, Angel Investing for Women by Women. There are many other angel groups. You can find more on Gus.com, although I believe they just renamed it into something else, or through Angel Capital Association. You can find various angel groups in the area, review their criteria and how they work. Some angel groups form a fund, and the angel group invests from the fund. Some do it differently. In the Dingman Center, for example, each angel makes their own investment decision. They may form a group of 4 or 5 investors to invest in a company. So each group works differently. Familiarize yourself and see if that's the right fit for you. My name and email address and phone number are listed here. You can always reach out to me if you have questions about any of the opportunities that I discussed. So please feel free to discuss, see what's right for you, how can we help. We also have entrepreneurs in residence on staff who can provide more information. And I will share these slides so you can have all of the contact information and URLs. For now or for future, if you're just now thinking about starting a company, you get on to all of these funding opportunities. If you're just now thinking about it, but plan to contact all of these organizations later, you can have these slides. And as I mentioned before, this will also be posted on YouTube. So are there any questions about any of the opportunities I talked about or any comments? Well, I don't see any questions. If you do think of a question later, I'll be happy. Please send me an email. I'll be happy to respond. And as I mentioned, I will send around the PowerPoint presentation and a link to the recording. Yes, somebody just asked about the contact information. I will send an email with the link with the slides, so you should be able to see it there. And obviously it's going to come from me, so you'll have my contact info. And here's my email address. So again, thank you so much. I understand that there was a power outage, so it was a hectic morning for everyone this morning. So thank you for those who made it. And for those who are watching it on as a recording, also thank you. Wish you a very good the rest of your day.